Hello, everyone, and welcome to our second webinar on elements of customer risk. My name is Anu Sood, and I'm the Director of Marketing at CaseWare RCM and today's moderator. In today's webinar, we will be talking about how to use your products and services, customer activity patterns, and behaviors for risk scoring. Now, here's a little bit about our presenter today. Lori Kelly has a 35-year career spanning the fields of accounting, finance, risk management, and regulatory compliance. Most recently, she served as a Director of Compliance for CoBank ACB, a $130 billion farm credit system, where she developed and managed the bank's anti-money laundering, fraud, and economic sanctions compliance programs. She holds CAMS designation as well as a CAMS audit specialization, and she helped found the ACAMS Colorado chapter and served as its executive board chair and programs director. With that, I'd like to pass the presentation over to Lori.
Well, thank you, Anu, and hello, everyone. And once again, welcome to the second of our three-part webinar series on the elements of customer risk. Now, before we get started, just a quick disclaimer. Everything I'm sharing today is from the perspective of U.S. regulations. So if you're based outside the U.S., please just keep that in mind. However, most of what I'll be discussing today is relevant to everyone, regardless of your locale. Now, today we're going to start with an exploration of, again, just what is risk and why do we care about it? And next we'll explore some concepts around categorizing, quantifying, and measuring customer risk from a money laundering perspective. Then we'll go deep into a number of risk factors associated with specific financial products and services and talk about the importance of the ever-evolving customer risk score. We'll wrap up with some concluding comments and then open it up for your questions. So let's get right to it. So when we talk about risk, what exactly do we mean? There are many ways to define risk, but I like this one. To take a risk is to intentionally interact with uncertainty. And uncertainty is something that may or may not occur, which we can't predict, or if it may occur, if or when it may occur, I should say, and we can't control whether or not it will occur. We're here today to talk about the risks associated with products, services, activities, and behaviors within the context of a customer's overall money laundering risk score. So just to be clear, we're talking about the overall risk that your customer may conduct money laundering activity or some other financial crimes through their account with your institution that you don't detect. So therefore, later on, when this activity comes to light, it could subject you to all kinds of regulatory, financial, and reputational problems. Now, let's face it, any new or existing customer has the potential to use the institution for illegal activity. That's where the uncertainty piece comes in. Now, obviously, without customers, we'd have no risk, but we'd also have no business either. So we look for ways to manage this risk rather than eliminate it altogether. And it's important to recognize that everyone perceives risk differently in any given situation. And I've found this to be especially true when it comes to customer money laundering risk. Now, as AML professionals, our world revolves around this, so it's important that we have a heightened awareness of what makes a customer at higher risk for money laundering activity. In our first webinar in this series, we talked about characteristics of the customer, their demographics, so to speak, that have a higher money laundering risk. Today, we're going to dive deeper into the different types of financial products and services that have a greater propensity to facilitate money laundering. And then we'll talk about customer transaction activities and behaviors and how these impact a customer's risk score. Now, customer risk rating or risk score helps us identify those customers who present a higher risk of money laundering or illegal activity. And why should we do this? Well, first of all, if your institution is subject to US law, you're required to. What's commonly known as the FinCEN Customer Due Diligence or CDD rule became law on July 11th of 2016 with a final compliance date in May of 2018. Now, among other things, the CDD rule requires that a financial institution should establish an understanding of the money laundering and terrorist financing risks of its customers, which the rule refers to as a customer risk profile, what we commonly call a customer risk rating or score. Now, this risk rating then points us to the customers whom we should be monitoring more closely for possible money laundering activity. And because we simply can't monitor every customer in depth, we have to focus on those who present the higher potential risk. Now, the challenge that's faced by compliance professionals, to me, is not in understanding the why of customer risk rating. I think we all get that. The challenging part, as with so many regulatory requirements, is how do we do it? So in this webinar series, I'm hoping to give you practical information and tools to help you figure out the how of customer risk rating. What I won't be able to cover are all the aspects of customer risk rating that are unique to your institution. Mainly, how you should ultimately build your customer risk scoring model, how you choose to weight certain risks or scores, and how you build customer risk scoring into your transaction monitoring software. There are many different factors that come into play when we're assessing a customer's money laundering risk. So many, in fact, that it's logical to group them into categories. The most widely accepted categorizations are what you see here in this pie chart. Now, in this chart, each risk category does appear to have an equal share of the total risk, but that doesn't necessarily have to be the case. Just for now, let's talk briefly about each one of these categories. Now, the first category is customer profile and relationships. Now, some call this customer demographics or simply customer risk. But I find that naming gets a little confusing, but regardless, it's the risk factors associated with characteristics of the customer, and especially for legal entity customers, their relationships to other individuals and other legal entities. Now, this category was the subject of the first webinar in our series. The next one is products, services, activities, and behaviors. It includes all the things the customer will do or is doing through your institution. In essence, it's about how the products and services the customer uses and their transactional activities and behaviors or patterns of behavior can have a higher money laundering risk. And that's what we're going to focus on in today's webinar. So if you think about it, the first category is about who the customer is. The second category is about what the customer does. And then the third category, geographic risk, is about where the customer does it. It being payments, both incoming and outgoing, as well as locations of assets, business relationships, and so forth. Now, this is then tied to money laundering risk associated with individual countries. In our upcoming third webinar of the series, which is on April 7th and 9th, I'll be describing a methodology for risk scoring individual countries from a money laundering and terrorist financing perspective. Then these country money laundering risk scores come into play when you're evaluating how risky are the places where your customer is sending or receiving funds or has other significant connections. Now, let's pause for a quick moment for a poll question. How automated would you say is your customer risk scoring process? Go ahead and give your response, and then we'll have Anu give us the results.
All right. So Lori, 22% said it's completely automated. 22% said it was completely manual, and 54% said that it's a bit of a mix, and could use some improvement. There was 2% who said too many AML systems to get a holistic view of risk.
That's good. At least that's about what I would expect to see, I guess. Sort of a mixture there of automated and manual and
Manual,
a little
yeah.
bit of both.
And,
Yeah.
and I think one of the things that we hope is that people can adjust it as needs change.
Mm-hmm. So before we get into details about the risk factors that are associated with products, services, activities, and behaviors, I want to talk just a little bit more about quantifying and measuring customer money laundering risks in general. Because risk is a somewhat nebulous concept involving uncertainty, we need some way to quantify a particular customer's risk, starting with an objective model And then if it's appropriate, adjusting that risk score using actual experience with that customer and professional judgment. Now, most risk scoring models are often way too complex, and whether this is in response to regulatory scrutiny or changing perceptions of customer risk or trying to apply whole different risk models for each business segment, or maybe it's just a matter of overthinking the issue. But nevertheless, some leading financial institutions are now exploring a simpler and more holistic approach. And they're doing this by creating a consistent set of risk factors and then determining the specific inputs that are relevant for each line of business. Now, while this is a whole separate topic of discussion, I want to highlight that just keeping your risk scoring model as simple as possible while maintaining its effectiveness is an important goal. And as I said earlier, we're not going to get into a whole lot of detail about the nuts and bolts of designing a risk scoring model, because that's up to you based on your institution's perceptions of risk. What I will be exploring with you today are many different risk elements relating to products and services and customer activities and behaviors that you may consider incorporating into your model. Now, one last point about customer risk scoring. And that is the customer risk score is something that really should be dynamic, meaning it may likely change and evolve over the life of that customer relationship. And that's because with a brand new customer with no history with the bank, an initial score is never going to be perfect, no matter how complex your model. It's going to take time to actually see how that customer behaves to develop a more accurate profile. So as a very simple example, let's say we have a new business customer who has a number of higher risk factors based on elements in all three of those categories we just reviewed. Now, initially, this customer may come up with a high risk score, which means that we're going to watch their transaction activity fairly closely to see if it matches up with what the profile indicates. If it doesn't, then after a time, we could lower that risk score somewhat and therefore their corresponding transaction monitoring thresholds. Now, on the other hand, you could have an initially low risk customer who could suddenly begin engaging in out of pattern, high risk transaction activity, maybe even to the point that a suspicious activity report or SAR is filed. Now, this low risk customer is now high risk and their risk score should change to reflect that. Now, in the first webinar in our series, we explored various risks presented by the nature of the customer itself or himself or herself. In today's presentation, we're going to go deeper into the what and the how category of customer risk, meaning the products and services a customer uses and the activities and behaviors they engage in while using those products and services. Now, as we get into this, please keep in front of your mind that all these risks are very much intertwined. Every customer has a unique set of characteristics and uses their products and services in certain ways. And together that comprises their overall risk profile. Now, coming up next, I'm going to talk about the money laundering risks associated with different products and services. And then I'll go into certain types of customer financial activities and behavior patterns that may be red flags for money laundering or other illegal activities. And as we go through this presentation, be thinking about where these may be relevant for your financial institution. And just speaking of financial institutions, I want to say upfront that I will not be covering anything specific to life insurance companies or casinos, as their money laundering risks are very, very specialized. So our focus today will be primarily on banks and similar types of financial institutions. So before we go into the money laundering risks of products and services, let's first define what is a product versus a service. Here are just some samples of both. And by the way, this list is by no means exhaustive. But essentially, a product is a type of account or financial instrument. And a service is an activity or transaction that's performed on a product. So for example, a checking account is a product. The services the financial institution offers to the holder of this product are, say, check writing, wire transfers, cash withdrawals, and so forth. Now, a service can also be a standalone financial service, such as trade finance, or say issuing a cashier's check in exchange for cash. or even foreign currency exchange. So in some cases, a service may not require the existence of an underlying product. So now what do we mean by activities and behaviors? Well, they sound a lot alike, and they are, but with some subtle nuances. In essence, activities are the use of services. And hopefully you haven't forgotten the definition of services we just mentioned. But for example, a customer with a checking account may write checks, make deposits, and say receive incoming ACH debits. All of these are activities, and activities occur in patterns in terms of transaction types, amounts, timing, and so forth. When a customer opens a new account, the bank should establish what that customer's anticipated transaction activities on the account will be. And then over time, most customers fall into a relatively steady pattern of activity. It might vary from this pattern at different times of the year, especially for business accounts, but over time, there should be some consistency. And it's the deviations from that pattern that the bank needs to investigate further. Now, behaviors are more about how a customer performs an activity. And a perfect example of behavior is structuring. Structuring is, of course, when someone makes cash deposits of $10,000 or less with the intent to avoid currency transaction reporting requirements. The activity is cash deposits, and the behavior is making smaller deposits so a CTR won't be filed. Now, activities and the behaviors go hand in hand, so don't get too hung up on the difference between them. Just remember, it's all about how a customer uses financial services. We'll get into more details on this just a little bit later. Now, in this illustration, we have a simplistic example of how products, services, activities, and behaviors can all be interrelated. We're going to get into the specifics of all of these and more in the next section, but this gives you an overview. Here we have an account holder with one product, a personal checking account, and she's had it for about 6 months. Now, the regular activities she conducts on this account are writing about 20 checks every month and having her account debited every month for her phone bill or cable bill and her auto insurance. But then in 1 month, she receives a couple of incoming foreign wire transfers, and shortly thereafter, she initiates an outgoing wire through the online banking system to a US recipient in another state. And she also receives some foreign incoming funds through an ACH credit. And then over the course of 4 days in 1 week, she makes cash deposits at the teller window of $9,900, $9,800, $9,900, and $9,400 respectively. Now, in her account opening documents, she said she had no plans for any foreign activity or any wire transfers, just about 20 to 25 checks a month and debits for typical monthly bills. So here we have an account with routine and normal activities, some out of pattern activities, and a potential structuring behavior going on. Now let's do one more poll question. How easy would you say it is to update your current risk scoring process? Once again, give us your response, and then Anu will give us the results.
So Lori, good news. So 35% said completely configurable and can easily show audit trail.
Great.
54% said mostly adjustable, but a pain to complete.
Mm-hmm.
7% did say, sure hope I don't have to change anything. So there's some people who are facing some pains. And 5% said, what risk scoring process?
Oh, no.
Oh, no.
Now we're going to get into more detail about the characteristics of products and services and what makes them more or less risky from a money laundering perspective. Honestly, pretty much any banking product can be used to launder money if you're creative enough, but some products are more vulnerable or more attractive than others. And it tends to be more about the underlying characteristics of a particular product than its name or its category, because banks are always coming up with new and innovative offerings, right? So as we talk about the characteristics that make a product more vulnerable to being used in money laundering, keep in mind the 3 phases of the money laundering process, right? Placement, layering, and integration, and where particular characteristics might facilitate one or more of these phases. So a product's characteristics that give it greater money laundering risk are these. It offers a higher level of anonymity, meaning lots of things can be done without face-to-face client interaction. Allowing for cash transactions, meaning deposits and withdrawals. Remember the placement phase. Allowing foreign transactions, either incoming or outgoing. Offering high-speed funds movement. Wire transfers are a perfect example of high-speed funds movement. A high volume of transactions expected in the account, meaning something suspicious might get buried in all the activity. And a product may actually facilitate a particular type of money laundering method, and we'll get into that in a moment. So when you assess your institution's product risks, look at all these factors and any others that you think are important. When you think about it, it really comes down to how much flexibility a product provides. The more flexible, the easier it is to use for placement or layering of illegal funds. Now, I want to keep emphasizing that no risk factor exists in a vacuum, especially when it comes to product risks. Most products don't serve much of a purpose without their corresponding services, right? Now, I suppose one exception might be, say, a long-term certificate of deposit or other type of long-term investment. Once you put the money in, you can't take it out for quite a while. This, I suppose, could be part of the money laundering integration phase, but not a typical one. It's also kind of scary that despite regulations, the banking industry, and more specifically the payments industry, is making it easier and easier for money launderers. Think about it, we're moving further and further away from face-to-face customer interactions as online and mobile banking, same-day ACH, and person-to-person payments like PayPal and Venmo take over. I mean, think about it. When was the last time you went into your bank to make a transaction? You can even make cash deposits at most ATMs now. And the bank where I have my personal accounts has actually eliminated tellers altogether at many of their branches. So what this points to is that it's even more important than ever to monitor activity and behavior patterns in customer accounts. So now let's take a look at a sampling of product types and assess their money laundering risk using those factors. So a personal checking account is probably the most flexible and accessible product type there is. You can do transactions anonymously through online or mobile banking. You can deposit or withdraw cash. You might be able to send or receive foreign wires or ACH, hence the question mark in the foreign transactions category there. Now, the one-year CD might permit a few cash withdrawals depending on features. So that's why the question mark is there for cash transactions. Otherwise, it's pretty risk-free. It wouldn't help a money launderer that much. Same thing with brokerage accounts. Now, a commercial letter of credit is used to facilitate imports and exports. So naturally, there are foreign transactions involved, and they're used in trade finance, which facilitates a particular type of money laundering called trade-based money laundering. Now, that's a subject for a whole other webinar, so I won't go into much more detail on it, but if your bank offers trade services, it's important that you understand those risks. Now, the last one shown here is a residential mortgage. And it's interesting that how loans and mortgages are getting a lot more attention in recent years because of a growing trend in real estate-related money laundering. Now, the Financial Crimes Enforcement Network, or FinCEN, classifies the real estate market as a particularly attractive market for money launderers due to the fact that a purchased property appreciates in value over time, which protects the buyer from market instability, and it allows for laundering a large amount of illegal funds with a limited number of transactions. So essentially, loans and mortgages are used to obscure the source of the illicit funds and then integrate them into assets of high value. And they take out a mortgage as a cover even, and then repay it either in a lump sum or in cash payments just below that reporting threshold. Now, by the way, this chart format is actually the way that I assessed my bank's product risks. And we'll talk about that in a little bit later. But it's important to lay out the main characteristics that make any particular product higher risk from your institution's perspective. With this method, you're effectively scoring each product based on a range of how many check marks each one has. So now let's look here at services. The same characteristics of risks that apply to products also apply to services. So let's look here at a selection of services and talk about their risks. Now, the first one is remote or mobile check deposit. Now, by the way, there is a difference between these two terms. Remote check deposit is a service primarily for business accounts. The business customer has a check scanner device that they use to scan in the fronts and backs of large batches of checks, oftentimes with an electronic endorsement that's automatically added. And the entire batch is then submitted electronically to the bank for processing. Mobile check deposit is what you do with your smartphone. You take separate images of the front and back of the check and submit it for processing. Each check is its own batch per se, and you can't image more than one check at a time for one deposit. Now, the primary risks with either of these is a form of anonymity. Because there's no teller looking at the actual checks, there's an increased risk of a couple of money laundering techniques going on. The checks being deposited could be, say, a bunch of sequentially numbered money orders that have been purchased with dirty cash. Same thing with sequential cashier's checks or counterfeit checks or checks that don't have any connection to the customer. Now, this was something that historically tellers were very good at spotting. Wire transfers have always been a money launderer's favorite tool. The most wire transfers today are initiated anonymously through online banking. And wires move money around the world in a matter of minutes. And while FinCEN requires certain key information to be included on a wire transfer, unfortunately, the US Federal Reserve doesn't verify that this information is present. So a lot of detail can be deliberately left off a wire transfer's instructions and information so as not to disclose its purpose or to avoid being flagged as suspicious. Check writing is, on the other hand, pretty low risk. A check is a permanent record, even though the paper doesn't stay around very long as they're now converted to electronic images. On the other hand, a cashier's check written in exchange for cash is high risk, especially if there's a pattern to this activity. This is a classic form of placement, meaning converting dirty money into a legitimate form. The risk is exponentially higher if the bank does this for non-customers. I'm not sure how much that happens anymore, but it is possible. Now, the last one, private banking, could also be the topic of a whole other webinar, but let's just talk about it briefly. Private banking services offer a very highly personal and discreet delivery of a wide variety of financial services to high net worth individuals and their corporate interests. On average, we're talking about someone with investable assets of at least $1 million or more. Customers most often seek out private banking services for, well, privacy, right? This might be based on reasons of public prominence or family considerations or sometimes even tax considerations. The private banking relationship is usually managed by a single person called a relationship manager who's responsible for providing a high degree of personalized service to the customer, oftentimes foregoing standard bank policies and controls. And because of the focus on privacy and confidentiality, it's not unusual for private banking services to actually include helping a customer set up offshore vehicles like personal investment corporations, trusts, or even more exotic types of arrangements. And these are, in essence, shell companies incorporated in places like the Bahamas, the British Virgin Islands, the Caymans, and other offshore financial secrecy havens. And they're formed to hold the customer's assets. Private banking has been at the center of many major money laundering cases over the years, and it's probably been the cause of many sleepless nights for a lot of bank compliance officers too. So how would you incorporate products and services risks into your customer's risk score? Well, remember the risk score is comprised of the 3 categories of risk: customer characteristics, products, services, activities, and behaviors, and geographic risk. If you're using a point scoring model, I'd suggest you start like this. First, just do a complete inventory of every product your institution offers and every service. Now, this can sometimes be a pretty daunting challenge all by itself. Then, much as you saw on my previous slides, you'll identify the money laundering risk characteristics that could come into play. And for each product you have, you'll essentially be scoring it from a money laundering risk perspective. The more characteristics it has, the higher the potential risk. And then you determine how you want to bucket these scores into low, medium, and high. And next, you'd assign a point value in your customer risk score model for those products and services that you rank medium or high. Now, if a particular customer indicates up front that they'll be using any of these, they get points added to their score for each one. And ultimately, the higher their total points, the higher their risk. Always keep in mind, however, that this needs to make sense from your financial institution's perspective. And to give you an example of what I mean by this, at my bank, our flagship product was a revolving line of credit for medium to large business clients. And the only way for a customer to advance funds off their line of credit was by wire transfer. So every single customer had wire transfer as a service. I didn't include the general service of wire transfers in our customer risk score calculations because literally every customer had it and every customer used it on a daily basis. So it wasn't a factor because it was normal for everyone. Now, foreign wire transfers were a different story, and those were less common, and we did consider them a risk element. So all I'm saying is make sure you're tailoring your model to your unique environment. Now let's switch gears a bit and explore certain types of transaction activity and behavior patterns that are considered high risk or red flags for money laundering activity. And before we talk about specific activity and behavior patterns, let's start with the end in mind. Remember that the ultimate purpose of an anti-money laundering program is to detect and report suspicious activity. Now, it's not up to us to do our own investigations to prove something illegal is taking place. We're just supposed to report it. And then once a bank detects and then decides to report a customer's suspicious activity, it's then up to the institution to determine whether or not it wants to continue with that customer relationship. Now, in some cases, like with my bank, terminating a customer relationship was simply not an option because our accounts were very large commercial revolving lines of credit with 5 to 7 year terms. And our average line of credit was 10 to 12 million. So we're talking very big loans. There was just no way that my bank would call a loan, meaning close the account, based on compliance's suspicion that the customer was doing something illegal, no matter how much evidence I showed them. Short of an indictment, it wasn't going to happen. So what does that mean for compliance? Well, it means we need to adjust a customer's risk score to reflect that they're now high risk because of their activities or behaviors, despite what their original calculated risk score was. Now, how you do this will be unique to your institution's AML system. One way to do this that's very transparent and simple would be to have some risk scoring elements for different levels of suspicious activity. For example, you could structure it like this. You'd have one risk element for, say, out of pattern activity, but no SAR filed. Then another could be SAR filed, and yet another could be continuing activity SAR filed, meaning they're continuing to do the same suspicious stuff after the first reported activity. And each one is worth more points, so it would push the customer's score into a higher or highest score range, and then the transaction monitoring threshold in the AML system would then reflect that high risk. Now, there are many, many different red flags for suspicious activity and behaviors. So instead of trying to cover all of them, I'm just going to highlight some of the ones that are most significant and or are on an upward trend these days. First and foremost, recognize that the foundation of nearly all suspicious activity is activity or behavior that's different from what's expected from that customer. For a new customer, anticipated activity is all we've got to go on at the beginning based on what they've told us. For a customer that's been with you for a while, you'll have a historical pattern of activity to compare to. If what a new customer does is significantly different from what they told us up front, well, that's a red flag. If an existing customer suddenly starts doing something that's way off from their normal patterns, that's a red flag too. Now, there could, of course, be a legitimate reason, or there might not. That's up to you to ascertain. So let's look at some of these high-risk patterns of customer activity and behavior. The first one I want to talk about is an oldie but a goodie, and that's structuring. Structuring is probably the most commonly known money laundering method. And simply put, it's where someone designs or plans cash transactions to avoid triggering a reporting requirement. Now, structuring can be done by some ordinary Joe who thinks he needs to keep it a secret from the IRS that he sold his fishing boat to his brother-in-law for $12,000 in cash. So he goes to one branch of his bank and he deposits, say, 7,000 of it, and then he goes to another branch across town for the other 5,000. But it's much more likely that people engaged in structuring are money mules or runners, sometimes called smurfs, who are hired by the launderers. And they go from bank to bank and branch to branch, depositing cash, withdrawing it from ATMs, and buying money orders, all in amounts just under the reporting threshold. Structuring can be done in many different settings, from banks to money service businesses and even casinos. Now, your AML technology should definitely have a means to detect potential structuring activity. The next one I want to talk about is something called a funnel account. Now, this is a money laundering method that's been around for a few years now, but it continues to grow. So much so, in fact, that FinCEN has issued 3 separate advisories relating to funnel account use. So what is a funnel account? Well, it's an ordinary account that's used to launder money by exploiting the branch networks of financial institutions. So illegal funds are deposited into the account at one or more locations by money mules, and then the criminals withdraw the money from a different geographic location. So in this graphic here, it shows how dirty cash is deposited into a business account at various branches on the East Coast, and then withdrawn from that account at a branch in Los Angeles. Now, this illustration goes further to show how the cash from the funnel account is then being used in trade-based money laundering. Basically, someone then sends wires or issues checks from the funnel account to a US or a foreign-based business to purchase goods that are then shipped to foreign countries for sale. And once the goods arrive, they're sold, and the proceeds wind up with the drug traffickers or money launderers. Now, funnel accounts are also used by human smugglers. US-based family members pay smugglers to bring their relatives into the United States, often by depositing cash into a funnel account. Now, there are about a dozen different red flags for funnel accounts, but here are the most significant ones. Obviously, multiple deposits where the funds are then quickly transferred to another account or other accounts, either on the same day or soon after. Again, multiple deposits from multiple locations that may be outside of the regional area where the account was opened. Lots of deposit activity, but then the account has a low balance. So all the money is always being moved out of it. Deposits coming in from different individuals or companies, and deposits from lots of different sources like cash, ATM deposits, check deposits, incoming wire transfers, and so forth. Now, in the first webinar in this series, I spoke at length about the higher money laundering risks associated with commercial or business customers. And one of the key drivers of this is how legitimate businesses are being used to launder criminal proceeds. It's been well established that money laundering commonly involves getting the proceeds from illegal activity into a legitimate, respectable business in order to make it appear normal and legal. The more profitable organized crime becomes, the more important it is for them to find ways to shift profits into legitimate activities. They need a reliable legal income, otherwise their lifestyle will eventually attract unwanted attention. Now think about it, you can't sustain a luxurious lifestyle without spending large amounts of income on goods and services. They have to make this income appear to be from a legitimate source. So this last type of suspicious behavior I'm going to talk about is all about what's going on in your business customers' accounts. The businesses tend to have a very stable pattern of receipts and disbursements, right? They bring in pretty much the same revenues, they pay the same vendors. Even if their business is seasonal, there's still a fairly predictable pattern over the course of a year. So when some new and unusual transactions happen, that's a red flag, and you need to pay special attention to these kinds of activities. Sudden use of incoming or outgoing wire transfers when they've never used wire transfers before. Patterns of incoming wire transfers followed by one or more outgoing disbursements, either wires, checks, or cash withdrawals, that add up to close to that of incoming funds. This could indicate they're acting as an intermediary in the layering phase of money laundering, and they're probably getting to keep as much as 10% of the funds as their compensation. Or, and I saw this a lot, it could be a fraud situation where your client account holder has a small business and they've fallen for a scam where they believe they can make some easy money by receiving funds into their account and then sending that money elsewhere, and they're allowed to keep 10% for their quote unquote fee. Now, foreign wire transfers are another red flag, especially if they don't do any overseas business. Incoming round amount wire transfers of just under 50,000 are also a red flag. For some reason, amounts from 25,000 to 49,000 seem to be some kind of magic number when it comes to fraud and money laundering. I think maybe they believe these amounts are less likely to be detected by a bank's monitoring system. And explanations that are given by customers for unusual transactions that don't make sense or don't seem to have a valid business purpose. And I'll give you a real life example of that. I had a business customer who did a lot of foreign exports of fruits and vegetables through open account trading, so they routinely received wire transfers from all over the world directly into their account. Now, one time, they received a $50,000 even wire transfer from a sender that was a company in the United Kingdom. However, the bank that sent the wire was in Latvia, and the explanation recorded in the wire transfer instructions was, quote, for payment of Sony home theater system, model number something, something, something. And then a few days later, they received another identical incoming wire transfer, same amount, same bank, same instructions. So we actually looked up that Sony model number and found it was real, but it was one that was only sold in the UK and it cost about $1,200 in US dollars. Certainly not $50,000 or $100,000. So we had this customer's relationship manager reach out to them with copies of these wire instructions via email, and he asked them about the business purpose of these transfers. And their response was via email, and again, I quote, these payments are from a buyer in Vietnam who pays us on account. Okay. Well, the story goes on with them continuing to receive more bizarre incoming wires like that from what we identified to be shell companies in a number of countries, all coming through banks in Latvia, with other strange explanations like for computers or even for clothing. Now, this otherwise low-risk customer was now very, very high risk. Now, I've been emphasizing throughout this presentation how it's so important that customer risk scores be dynamic, meaning they can and most likely should change over time as you develop experience with each customer. And this is because any customer risk score at the outset of the relationship is never going to be perfect. It's an assessment based on objective data and predictions of account activity. But as the relationship continues, a customer is going to add new accounts or services, especially if your institution starts offering something new. Individuals relocate, people change jobs, their circumstances change. Business customers may expand and grow their revenues, add new product lines, start exporting even. It's pretty rare that nothing will change. So the risk score often will change as these underlying factors change. Now, that's not to say that many customers may start as low risk and stay that way forever. And wouldn't it be wonderful for all of us in compliance if that were actually the case? Hey, we can dream. But statistically, that's probably not going to happen. So when the underlying risk factors change or actual activity or behaviors start going out of pattern or into downright suspicious patterns, you have to be ready to up the risk score and monitor more closely. As well, when a risk score changes, it may be a prompt that some further due diligence is needed. Maybe talking with the customer about what's going on with their business, looking into their business ownership structure more deeply if it's, again, a commercial account, and so forth. And just as a risk score can go up, it should also come down if the underlying risk is mitigated or found not to be as big a deal as you initially thought. And this is where your professional judgment comes into play. And your decision is going to be unique to that particular customer. Just make sure that you document your rationale in writing every time. So how about another poll question? How comfortable are you that your current systems are capturing all the relevant customer risk elements in an efficient manner? Give your answer and then we'll get the totals.
So poll results have come in, and so 17% say they're extremely comfortable with
Good.
that they're capturing the relevant risks. 69% so say they could use some improvement. 11% are not comfortable at all. Um, and 3% did say things are working but takes too much time. So I think the bulk of the respondents said they're either extremely comfortable or could use some improvement. So I think that you would normally expect something like that from a poll question like this.
Yeah. Okay. Well, we're going to wrap it up here now with some concluding comments and then we'll do your questions. So we've explored today the money laundering risks that are associated with different types of products and services and how the customer's actual transaction activities and behaviors are what ultimately validates the money laundering risk score. And I'd like to just wrap up with some general recommendation regarding risk scoring models. As I mentioned at the beginning, you should consider keeping your risk scoring model as simple as possible so that it's clear and logical and relatively easy to test and modify as needed. Consider scoring your institution's products and services from a money laundering risk perspective, so then you can clearly demonstrate why certain ones are higher risk than others. And however you choose to build your model, make a formal record of how the model is designed, what's your rationale for the specific risk factors you're including, and why you may have chosen to weight them differently if you do so. The reason is good documentation provides a clear reference that you can share with regulators, your management, internal audit, as well as relevant compliance staff so they understand it. And also along those lines, be sure to educate your frontline staff about risk factors that are associated with products and services, as well as how to recognize suspicious activity. It's important that they understand not just what the risk factors are, but also why. And this helps them better understand money laundering risks in general. And next, it's very important to find ways to make sure the customer information on which your scoring model depends is kept up to date, so the risk score can evolve as things change. And I must say, this is probably one of the biggest challenges that's faced not just by financial institutions, but all types of organizations, keeping up with customer information. And unfortunately, I have no easy solution to this. If I did, I could probably make millions. But make sure you have a logical way to increase a customer's risk score when their activities become suspicious or a SAR is filed. And also use and if necessary, enhance your AML technology for these purposes. A good AML monitoring system should be able to incorporate machine learning so it knows when something changes and either alerts you or updates the risk score automatically and alerts you so that you can go back and take a look at it. AML monitoring systems must be able to evolve their detection capabilities as new money laundering techniques emerge as well. I want to also reemphasize again that no single factor exists in a vacuum. All the risks we've explored today should be considered together along with customer profile and relationship risks and geographic risks, which we'll be talking about in our final webinar coming up in April. And most important of all is to always consider customer risk scores within the context of actual customer behavior. A low-risk customer from a score perspective whose account activity appears to indicate, for example, that it's a funnel account, shouldn't be low risk any longer. Similarly, an initially high-risk customer who maintains a steady and predictable pattern of transaction activity can potentially be downgraded to a lower risk category if the institution's risk tolerance allows. Now, I'd like to thank you once again for participating in our webinar today, and I hope you'll join us for the remaining one.
So before we do close, I'd like to remind everyone that this was part 2 of a 3-part series. And in part 3, which will be on April 7th or 9th, depending on your schedule, we will cover one objective methodology that financial institutions can consider to assess individual country risks, country money laundering risks, which in turn may be used in transaction activity monitoring, customer risk scoring, and the institution's high-level money laundering risk assessment. So if you haven't already registered, you can register through our website, or we will also be sending a link next week with the materials from today's presentation. So with that, I'd like to thank Lori for today's presentation, and this now concludes our webcast. Thank you very much and have a safe and great day.